Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
64 cents. As of this morning, early February 2026, that is exactly where DataVault AI, ticker DVLT, is sitting. It's hovering in this incredibly tight channel, bouncing between 64 and 67 cents. But if you're just looking at that price tag, you are missing the entire story. You have to look at the volume. The 90-day average volume is sitting at a staggering 70.78 million shares. This isn't some dormant penny stock that Wall Street has forgotten about. With a market cap holding steady at $367.07 million, this is a battleground.
It is a battleground, certainly, but looking at the chart, it looks more like a triage unit. We have to be honest about the context here. You mentioned the consolidation, but we have to zoom out to the trailing 52 weeks. This stock has seen a high of $4.10 and a floor of 25 cents. That is massive, stomach-churning volatility. Currently, we're seeing stability, yes, but let's be clear about what that stability follows. A precipitous 42% drop last November. The question we are facing isn't just about a tight channel. It is whether this silence is the calm before a strategic breakout, or the final breath before a total collapse.
And that tension is exactly why we're digging into this today. Because where you see a collapse or the potential for one, I see a pivot, a massive strategic pivot that the market just hasn't fully priced in yet. We're looking at a company transitioning from, legacy audio technology to a Web 3.0 AI data monetization firm. The central thesis isn't about where the stock was last November. It is about whether DataVault is building the future infrastructure for the multi-trillion-dollar real-world asset market. I'm looking at the patent portfolio, the IBM partnership, this whole concept of the tokenization of everything, and I see a misunderstood innovator.
And I am looking at the financials, specifically the cash burn and the management history, and I see a risk profile that, frankly, it borders on dangerous for the average retail investor.
Dangerous is a strong word.
And I don't think it's strong enough, but fine, let's start with your thesis. You claim this is an infrastructure play. Explain that. Because right now the market is valuing them like a failing audio company that's just trying to ride the AI hype train.
That is the inefficiency we want to exploit. The market is looking in the rearview mirror. DataVault isn't just selling software anymore. They are building the Information Data Exchange, or IDE. Think of it like the New York Stock Exchange, but for unstructured data. Companies today are sitting on, mountains of data, unstructured, messy, illiquid data. DataVault has the patents in the system to take that data, structure it, price it using their data value engine, and convert it into a liquid asset on the blockchain. They have DataVault Bank, which they built with IBM to secure it. They have DataScore for risk analysis. This is the plumbing for the digital economy.
I understand the model on paper. It sounds fantastic. We turn garbage data into gold, but we have to look at execution. Ideas are cheap. Execution is expensive.
It is more than paper. Look at the recent wins. They just secured a $7 million minting deal with MTB Mining Limited. That deal isn't just a press release. It is tangible validation. It includes a 30% perpetual royalty on the mineral resources documented on their ledger. They are effectively digitizing gold, rare earths, and minerals, assets that are real, tangible, and valuable, and putting them on the blockchain. That proves the technology works for real-world assets, or RWAs.
I will concede that the MTB deal is a tangible data point. A 30% royalty is significant if, and I mean this is a big if, the mining output matches the projections. However, while the narrative is compelling, the numbers underpinning this company right now are, they're terrifying. We need to look at the financial reality as it stands today, not in some imaginary future. The trailing 12-month net loss is approximately $94.2 million. That is nearly $100 million gone.
Scaling costs money. You know this.
Scaling costs money, sure, but look at the operating margins. They are negative 1,005%. For every dollar of revenue they bring in, they are spending $10 just to keep the lights on and run the business. That is not just scaling, that is an inferno.
You're looking at burn rates during the most capital-intensive phase of a company's life. They are building a supercomputer. They are deploying a national edge network. You cannot judge a construction site by how clean the floors are while they are still pouring the concrete.
But I can judge the price of the ticket to get in. Right now, DVLT is trading at a price-to-sales ratio of roughly 137 times annualized sales. Let's put that in perspective for the listener because that number is astronomical. A standard healthy tech company might trade at, 10 or 20 times sales? Let's look at their peers, or at least companies in the adjacent hardware/semiconductor space. Toyo is trading at 1.56 times sales. Everspan is at 4.11 times sales. DataVault is commanding a premium that suggests they are already a dominant market leader like NVIDIA, yet the fundamentals show a company just bleeding cash. The market keeps selling the news for a reason. The stock hasn't recovered the 200-day moving average of $1.02 since that drop in November. Why pay a Lamborghini price for a car that is currently on blocks?
Because you aren't buying the car, you are buying the dealership. Comparing DataVault to a semiconductor manufacturer like Toyo is a category error. Toyo makes chips. It's a commodity business. DataVault is a platform business. You have to look at the growth trajectory. We are talking about a revenue ramp from $2.7 million in 2024 to a projected $200 million in 2026.
Wait, let's pause right there.
That is the guidance.
That is the guidance, yes. But let's drill down into that because that brings us to our first core area of debate, the revenue ramp. You are talking about a 7,000% increase in revenue in 2 years. In the history of public markets, that kind of ramp is incredibly rare. It is an execution nightmare for even the most seasoned management teams. How exactly do they get there without tripping over their own shoelaces?
It is aggressive. Certainly, I won't deny that. But it isn't magic. It's math based on 3 specific pillars. First, the National Edge Network. They are deploying GPU-powered edge nodes across 100 cities. This isn't just software. It's physical infrastructure for the tokenization at birth of data. They are targeting $400 to $500 million in project revenue just from that rollout.
Targeting is the key word there.
But it's backed by contracts. Second, you have the M&A strategy. They are buying the revenue streams to support the valuation. The acquisition of CompuSystems, finalized in May 2025, is bringing in $20 million in expected revenue alone. The API Media acquisition adds engagement tools. They are rolling up these companies to create a vertical stack. It's a classic roll-up strategy combined with organic tech growth.
Buying a revenue and growing organic revenue are 2 very different things, especially when you are doing it with a balance sheet that looks like this. Let's talk about liquidity, the ability of the company to pay its short-term bills. The current ratio is 0.68. For those listening, a ratio under 1.0 means they do not have enough liquid assets to cover their liabilities due in the next year. The filings show a going concern notice. That is auditors speak for, we aren't sure this company will survive the next 12 months. They are burning cash to buy these revenue streams, it feels like. I don't know, using a credit card to pay off a mortgage.
Which is why the Silix investment is so critical. You cannot ignore the partner they brought in.
It is a capital injection, yes.
It is a $150 million vote of confidence. Silix didn't just write a check and walk away. They are funding the construction of the supercomputer and a biotech-specific exchange platform. That capital solves the immediate liquidity crisis and funds the infrastructure build-out. Silix sees the value in the digital twin technology for their own biotech data. They are putting their money where their mouth is.
It solves the infrastructure need for the moment, perhaps, but it doesn't solve the market sentiment. If you look at the broader context, DataVault is lagging behind the semiconductor industry significantly. The semi industry returned almost 40% over the last year. DVLT is down double digits. If this national edge network is such a slam dunk, and if they are technically an AI play, why is the stock decoupling so negatively from the sector? Why isn't the smart money front-running this?
Because, as the beta of 0.15 suggests, it's not moving with the sector. A beta that low means it is uncorrelated. It's moving on its own idiosyncratic catalysts. And this leads to the technology argument. You mentioned they are lagging the semi-industry, but DataVault isn't a chip stock. It's a competitive moat built on unique IP.
I want to discuss this moat, because moat implies a defense that competitors cannot cross. What do they have that Google or, say, Palantir doesn't?
The Acoustic Science Division. This is completely unique. They possess ADO technology, which uses inaudible tone to trigger mobile responses.
Explain that. Inaudible tone. It sounds like science fiction.
It allows a device to broadcast a sound frequency that the human ear cannot hear, but a smartphone microphone can pick up. This creates a secure, verifiable link between a location or a broadcast and a user's device without requiring an internet handshake or a QR code scan. They use this with fintech.tv for their bias meters. It's a way to verify engagement and identity physically. This is high-margin intellectual property that no other semiconductor peer has. They aren't competing with Kopin or Everspin. They are competing with Palantir and C3.ai, but with a specific niche in audio plus blockchain.
I struggle with an audio analytics as a sustainable moat. It feels like a feature, not a platform. Is the entire business model reliant on secret sounds? And while you compare them to Palantir, Palantir has government contracts that take decades to build. DataVault has a beta of 0.15, as you noted. That means the stock is moving randomly on hype and news releases rather than with broader technological adoption. It creates a chaotic investment environment where the price action is just divorced from the reality of the tech sector.
The low beta indicates it's an uncorrelated asset, which is exactly what you want in a diversified portfolio. You want something that zigs when the market zags. But I want to address the elephant in the room, because I know where your skepticism is really rooted. It isn't the audio tones, it isn't even the burn rate. It's the leadership.
It is the leadership, you're right. Specifically, the insider activity and trust. We have to talk about CEO Nathaniel T. Bradley.
I expected this.
It is material to the investment thesis. We have a CEO who has a regulatory history. In 2021, regarding a company called Parallax Health, there were SEC charges regarding false COVID-19 test claims. He settled a fine of $40,000. That is a matter of public record. When you are asking investors to trust you with a tokenization of everything play, essentially handling the world's most valuable assets, that history matters. Trust is the currency here.
And he paid the fine, and the 3-year prohibition has expired. That issue is closed. He's settled without admitting or denying guilt, which is standard.
But then we have the Wolfpack research report from October 2025, just a few months ago. They alleged the technology was a sham and claimed the operations were unsubstantial. That report caused the stock to drop 42% in a heartbeat. And while the company rebutted it, look at the insider actions. This is what concerns me most. In December 2025, just 2 months ago, while the company is publicly hyping this future revenue, the CEO and CFO were selling stock. Insiders sold $32.5 million total in the recent period. If the future is so bright, why are they selling at these lows?
Context is everything here. You can't just look at the sell headline. The bulk of that selling was Silex rebalancing their portfolio. Even after those sales, Silex holds 36.8% of the company. That is a massive holding. As for Bradley and Moyer selling, executives sell for tax reasons or diversification all the time. It doesn't negate the fact that DataVault is suing Wolfpack for short and distort.
Suing a short seller is often a sign of weakness, not strength. It distracts management.
Or it's a sign that they are fighting back against manipulation. They claim the allegations are hyperbolic, specifically the claims about operating out of a beauty salon. They are defending the legitimacy of the IP. Bradley is also the founder of Audio Eye, a NASDAQ-listed company that set industry standards for accessibility. He is an inventor with 20 years of experience. You cannot dismiss his technical pedigree based on a settled charge from a different venture.
I don't dismiss the pedigree, I assess the risk. And when you combine a going concern notice with a CEO who has a history of SEC settlements and a short report alleging fraud, the trust barrier is incredibly high. It's a wall.
High risk, high reward. That's the game.
That leads us to the practical application of this debate. We need to break down what this means for a portfolio. Let's stop talking in abstract millions and talk about a real trade.
Agreed. Let's look at the investment scenarios.
Let's assume a hypothetical $5,000 allocation made today. The stock is trading around $0.64. So you're buying roughly 7,812 shares. Walk me through the outcomes.
Okay, walk me through the risk profile first. Be the Grim Reaper.
The short-term bearish case is straightforward. They have a $30 million revenue target for 2025 that we are waiting to see confirmed. If they miss that target, or if the going concern issues force a massive dilutive capital raise where they print millions of new shares to pay bills, the stock likely retests the 52-week low of 25 cents.
And the math on that?
Your $5,000 investment shrinks to $1,953 almost overnight. That is a loss of over 60%. And that isn't even the worst case. The worst case scenario isn't just a drop, it's penny stock status where they get delisted or bankruptcy due to cash burn. In that case, it is a total loss of principal, zero.
That is a grim picture, but it ignores the upside skew. This is an asymmetric bet. Let's look at the midterm, say 12 months out. Analysts have a price target of $4 based on the successful rollout of the Edge network. That is a 525% upside from current levels.
If they hit the numbers.
If they hit the numbers, that $5,000 investment becomes $31,250. Think about that multiple. You are risking $3,000 to make $26,000. And if we look long-term, the bull case for 3 to 5 years involves hitting that $1 billion revenue mark, which is only half of their 2027 target. If they traded a reasonable 5x sales multiple at that point, you are looking at a share price of around $8.60.
So the long-term bullish math?
That $5,000 investment becomes over $67,000. That is the potential of getting in at the infrastructure layer of a new economy.
It's a lottery ticket payout structure. High probability of loss, massive payout if it hits.
I wouldn't call it a lottery ticket. I would call it a venture capital style bet available in the public markets. You usually don't get access to these types of zero or hero stages unless you are an accredited investor in a private round. Here it is liquid and available.
Which brings us to our conclusion. We have laid out the data. We have the vision of the digital twin versus the reality of the balance sheet.
We have. And for me, despite the risks you've highlighted, and they are real risks, I come back to the macro tailwind. The real-world asset market is projected to hit somewhere between $16 trillion and $30 trillion by 2030. That is an unstoppable economic force. Everything is going on chain, real estate, minerals, art. DataVolt is positioning itself exactly at the intersection of AI, blockchain, and audio to capture that value. It is a do-or-die phase, yes, but the upside is generational.
I acknowledge the macro potential. The tokenization of assets is likely real. But my final word is hold, not buy. The gap between recognized revenue, money actually in the bank, and booked revenue, money they hope to get, is the only metric that matters right now. Until I see audited proof that they can bridge the gap between 2.7 million and 200 million without destroying shareholder value through dilution, the regulatory baggage and insider selling make this too speculative for me. It is not a foundational investment. It is a gamble.
And that is the choice the listener has to make. Do you trust the vision of the digital twin economy and the patents backing it?
Or do you fear the going concern notice and the cash burn?
That is where we leave it today.
Until next time.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.